Someone says they own Bitcoin, but all they have is a ticker and a brokerage app. Is that really Bitcoin or just a Wall Street wrapper around it? That is the core question behind a spot Bitcoin ETF. The reason people still talk about spot Bitcoin ETFs is not just price attention, it is access. They turned Bitcoin exposure into something many people can buy through the same account they use for stocks, index funds, or retirement portfolios. A spot Bitcoin ETF is a fund that holds Bitcoin and issues shares that trade on a stock exchange. When you buy a share, you are not receiving Bitcoin in your own wallet. You are buying a claim on a fund whose value is meant to follow Bitcoin. The word spot matters. It means the fund is designed around the current market price of Bitcoin, not a later contract or a bet on what Bitcoin may be worth months from now. The fund's job is to reflect Bitcoin exposure as directly as possible. Before spot products, many investors could access Bitcoin through futures-based funds. Those funds hold contracts that expire and must be replaced. A spot Bitcoin ETF is different because the underlying exposure comes from Bitcoin held for the fund, not a chain of futures contracts. Think of the structure in 3 layers. At the bottom is Bitcoin itself. In the middle is the trust or fund that holds that Bitcoin through a custodian. At the top are exchange-traded shares that investors buy and sell during market hours. If you buy one share, your brokerage account records that share. You do not get a private key. You do not broadcast a Bitcoin transaction. You do not choose a wallet address. The Bitcoin sits inside the fund's custody arrangement. For many beginners, the biggest obstacle to Bitcoin is not the price chart. It is the operational part. Which exchange do you trust? Where do you store the coins? What if you lose the seed phrase? An ETF removes some of that friction. But removing wallet friction does not remove Bitcoin risk. If Bitcoin's market price drops sharply, the ETF is designed to feel that drop. The wrapper may be familiar, but the underlying asset can still be volatile and uncertain. Custody is the part most people cannot see. The fund needs someone to safeguard the Bitcoin's private keys. That custodian may use cold storage, controls around transfers, insurance arrangements, and internal checks. The exact setup depends on the product. Bitcoin ownership is controlled by private keys. Whoever can sign with the right key can move the coins. So in a direct wallet, key management is your responsibility. In an ETF, that responsibility moves to institutions chosen by the fund. The fund is not supposed to trade Bitcoin like a hedge fund searching for clever entries. A typical spot Bitcoin ETF has a simpler mission: hold Bitcoin, calculate the value of the holdings, issue shares, redeem shares, and charge expenses for operating the structure. If this kind of crypto plumbing explanation helps, consider subscribing. We focus on what actually moves, what is locked, what is signed, and what risks are hidden behind simple buttons in an app. Here is the puzzle. ETF shares trade on an exchange, where prices move because buyers and sellers are active. Bitcoin trades in crypto markets. How do the ETF shares stay close to the value of the Bitcoin held by the fund? The fund calculates a net asset value, often called NAV. In simple terms, that is the value of the Bitcoin it holds, minus expenses and liabilities, divided across the shares. If the fund holds more Bitcoin per share, NAV rises. If Bitcoin falls, NAV falls. The ETF share price can temporarily trade above or below NAV. Above NAV is called a premium. Below NAV is called a discount. This can happen because shares trade all day, while the fund's value is being estimated from underlying markets. The key actor is not the small investor. It is an authorized participant, often a large financial institution. Authorized participants can work directly with the fund to create or redeem large blocks of shares. That is the plumbing behind the ETF. Imagine, ETF shares are in high demand and trade slightly above the value of the Bitcoin behind them. An authorized participant has an incentive to help create new shares. More shares can enter the market, which helps push the ETF price back toward the underlying value. In many spot Bitcoin ETF structures, the authorized participant delivers cash to the fund. The fund's process then turns that cash into Bitcoin exposure for the trust. New ETF shares are issued in a large block and can be sold into the market. Now imagine ETF shares trade below the value of the Bitcoin behind them. An authorized participant can buy shares in the market and redeem a large block with the fund. Those shares are removed, and the process helps pull the share price back toward NAV. During redemption, the fund may deliver cash after selling the needed Bitcoin exposure, depending on the product's rules. The important beginner idea is that shares disappear and the fund's asset base shrinks. That pressure helps close the gap between share price and underlying value. This create and redeem loop is called an arbitrage mechanism. It does not guarantee perfection every second, but it gives large traders a reason to correct big gaps. That is why ETF prices often stay close to the assets they represent. If you own a few shares in a brokerage account, you normally just sell them on the exchange. You do not call the fund and ask for Bitcoin. The creation and redemption machinery happens at a wholesale level, not at the level of everyday accounts. Owning Bitcoin directly is different. You can withdraw to your own wallet, hold your private keys, send coins to another address, use Bitcoin outside market hours, and verify your balance on-chain. That control is the main point of direct ownership. With an ETF, you get convenience inside the financial system. You can use a brokerage account, see tax documents from that platform, and trade through familiar stock market tools, but you cannot use the ETF shares as Bitcoin on the Bitcoin network. The trade-off is simple but important. Direct Bitcoin gives you more control and more personal responsibility. A spot Bitcoin ETF gives you easier access and professional custody, but it adds intermediaries between you and the coins. Bitcoin trades around the clock. Stock exchanges do not. So ETF shares usually trade during exchange hours, plus whatever extended hours your broker supports. If Bitcoin moves heavily while the stock market is closed, the ETF may adjust when trading reopens. Spot Bitcoin ETFs usually charge a sponsor fee or expense ratio. That fee pays for the structure, administration, custody, and other operations. Over time, fees can create a small drag compared with holding the same Bitcoin directly, although direct ownership has its own costs. The goal is not to outperform Bitcoin. The goal is to track Bitcoin exposure after costs. If the fund is working as designed, the big driver should be Bitcoin's market price, not a manager's trading skill or a secret strategy. A common misunderstanding is that approval to trade means Bitcoin itself has been declared safe or endorsed. That is not what it means. It means the product met the rules required for listing and trading. The underlying asset can still carry serious risks. The reason the structure matters is that it connects Bitcoin to existing financial rails. Advisors, institutions, and individual investors can evaluate it using systems they already know. That does not make Bitcoin less risky, but it changes who can access exposure and how. There is also a debate about custody concentration. If many products rely on a small number of crypto custodians, operational problems at one major provider could matter. This is not the same as a Bitcoin protocol failure, but it is a wrapper-level risk. Direct Bitcoin ownership shows movement on-chain when coins are sent. ETF share trading mostly happens off-chain, inside securities markets. The fund's Bitcoin may move during creations, redemptions, custody changes, or fee operations, but your ordinary share trade is not a Bitcoin transaction. Different things can fail in each model. With self-custody, a lost seed phrase can be final. With an ETF, risks include custodian issues, market disruptions, premium or discount gaps, regulatory changes, and the normal possibility that Bitcoin itself falls in value. A crypto exchange account sits somewhere between these models. It may let you buy actual Bitcoin and withdraw it, but if you leave coins on the exchange, you still depend on that platform. An ETF goes further into traditional finance and usually does not allow withdrawal. Picture a fund with 1,000 Bitcoin and 1 million shares. Ignoring fees, each share represents exposure to a tiny fraction of that pool. If more shares are created, the fund needs more Bitcoin exposure. If shares are redeemed, the pool and share count shrink together. So a spot Bitcoin ETF is best understood as a bridge. It gives stock market-style access to Bitcoin price exposure. It does not give you native Bitcoin ownership, private keys, or on-chain control. The convenience is real, and so are the trade-offs. If one part of this still feels unclear, ask it in the comments. Do you want the next explainer to compare Bitcoin ETFs with Bitcoin futures ETFs, self-custody wallets, or Ethereum ETFs? Tell us what topic should come next.